Hey traders, this is Cousin Vinny coming to you on Sunday, January the 26th from theclosingprint.com with a look at the week ahead and some thoughts for this week of trading. If you woke up Friday morning after taking a nap, you were greeted by a huge down day on all of the indexes. There are a number of reasons why this occurred, but the main thing to bring from this news is that personally I don't find a reason or an edge to be trading currently. I want to wait until I see buyers again to go long. If I am taking shorts, then I'm looking for areas of support that are breaking. There are a number of stocks that is occurring on. So you could trade short currently. My mindset is that we're going to see further weakness as Monday there will be a number of margin calls, which plays right into setting up for our next longs. But at present I don't see an edge, so I am sitting on the sidelines. This is a chart of EEM, the emerging markets, and we can see that there was quite a bit of weakness on Thursday and Friday. Thursday foreshadowed or forewarned of a possible weakness in U.S. markets. When we look at a candle glance of the indices, the comp, the industrials, the Russell, the New York Stock Exchange, the middies, and so forth, we can see, along with the S&P 500, that we have a huge amount of weakness here. The emerging markets affected the Brazilian shares because of the concern over the Argentine currency and how that's going to affect Brazil and also Venezuela, the spillage over into these economies. So we see a lot of weakness here. If we look at some of the other indices, we can see that the Shanghai index did find a bottom. If we look at the chart, we can see that it found a bottom here in the 1946 range and has since started to move off of that area. So I'd be watching this as well. Looking at the comp, we took out these lows that we were seeing a bounce off of up until Friday. Bullish percent is dropping, which is actually a good thing for setups coming into the near future. The Nasdaq McClellan Index turned down. The Nasdaq Summation Index, gave us a crossover, so that's a bearish signal. And the number of stocks trading below their 50-period moving average on the Nasdaq is down to 59.69. So all of this is welcoming in terms of if you're setting up for longs. You can see percent B is getting down close to a buy area as well. Looking at the industrials, the 15,700 level would be about a 5% pullback, and the 200-period moving average here is about a 7% pullback. If we come down to these lows here around the 14,719 level, that would be about a 10% pullback. So we can run this trend line out and look for a possible bounce area in any number of these places. So that's what we should be looking forward to in terms of the industrials going forward in the short term, with this first level being this trend line that goes back to May, extending out here. The important thing to remember though, however, is that the industrials are only 30 stocks, so keep that in mind. Look at a more broad index like the Russell 2000 and the S&P 500, as well as the S&P Composite, which is 1,500 stocks comprising the 600 small caps, 400 mid caps, and the S&P 500 themselves. So you have to look at these as a whole, looking for areas where the market will set up for our next move higher. The SPS UPX is the S&P 500 Composite 1500. We can see we're coming right down to this trend line that extends out back to May. We could take this out on a Monday. We have the 382 right below that, and the 50% level if you extend this trend line out to a possible area of a bounce. Look at the breadth here at the bottom. Advanced decline percent leans more towards the mid caps and the small caps because there's more of them, and the up down percent is geared more towards the big caps. We can see that we took out the 20 period moving average, which is bearish in the short term. So you can print this out and look for these fib levels to play out over the next few weeks. 618 is a possibility as well, depending on the weakness that we see over emerging markets, the China bank issue with HSBC, as well as the Argentine currency issues, and if we throw in Iran to round off the negative catalyst, there's always a possibility that that could pop up as well. So there's plenty of catalysts out there to be cautious currently in your trading. The institutional index, the XII, we can see that we took out the previous pivot levels here at 806.94. This is a measure of all of these 75 stocks along the left side here that major institutions tend to hold as their core positions. So you want to watch these to note where they're buying and selling as they push the markets around. Notice the RSI is getting down to oversold. We could still see some further downside as margin calls come in on Monday. Stochastics is getting down to oversold. MACD is way oversold, and %B is down towards the lower levels, as well as CCI way oversold and ready for a bounce. Looking at the Russell, we saw some damage on Thursday and Friday as well, with RSI moving down through 50. We took out this level at 1147, a previous pivot that we took out towards the end of 2013, early 2014. We had this little channel and broke down through that now. We have a lower trend line right here that we'll be keeping an eye out at 1142 in that area. So if we break down through this with margin calls on Monday, we could see a further move down to the 1123 level, previous breakout level and support. Looking at the indicators here, we can see that stochastics could get further sold, as well as MACD, and CCI is getting down into the oversold territory, but could get down further here before we see a signal for a long on the Russell. If you're trading in your 401k and you're thinking about buying small caps. This is a chart of the fear indexes overlaid with the S&P 500. We can see that the VIX here has spiked into fade territory. We have seen previous spikes that have moved much higher. So in order for me to start thinking long again, I would be looking for things that Yukarwitz pointed out last week, if you follow him, for the advanced decline volume to be greater than 90%. We want to see a spike on the MAD, a major accumulation. We want to see CPC, the put-call ratio, to be above 1.2. The VIX to be outside of the Bollinger Bands. Okay. The trend to be greater than 2, and RSI to be less than 20. So RSI has a ways to go before it gets down to that territory, but we'll look at a few of these things. The main thing, though, keep an eye on the VIX and those indicators I just mentioned. You can watch this a couple of times if you miss some of this, but when you start to see an extreme like we see here between the XIV and the VIX, this plot here, that's when you start to appreciate the possibility that we might see a reversal in stocks. This is a plot of the S&P 500 with the more important indicator down here, which is the advanced decline percent. You look for the upper portion here is the New York up down percent volume. versus the down volume percent, we want to see following an MDD or a major distribution, which you can see when we pop up above 90% here on a selling day, we want to see a commensurate, a second spike in the MAD, a 90% up day in volume. So if you have stockcharts.com, you can create this indicator yourself by just using this chart here, up volume versus down volume, and down here with the down volume versus up volume to create your major distribution up days, major distribution down days. Okay, so what we're looking for now is a spike in the up volume showing that institutions are getting back in, coupled with an increase in the fear index, the VIX, as well as the trend, which this is a chart of. The trend here, you want to see spikes above 2, which is a reflection of the ARMS index. It compares the advanced decline issues relative to volume. Okay, so on spikes down with increased volume, you would expect this to spike above 2. We haven't seen that yet like we did here on that down day Monday a week ago, but that's what we're looking for. Here again is the S&P 500. We're looking at this reverse Kirby, a huge support level here in the 1690 range, as well as this ascending trend line that we're looking at, but more importantly looking at the bullish percent, which is really having a move down. We haven't gotten into an area where we could see a bounce yet. The New York Stock Exchange Summation Index gave us a sell signal on Friday. NIMO has not gotten down to minus 75 in this range here for a buy zone. MACD is on a sell signal. ADX is starting to show the strength of the down move. This hasn't gotten back above 25 yet, so we want to watch for a peak here and reversal, as well as the S&P 500 number of stocks trading above their very moving average is 38.4. So that's a huge spike down, getting down to a buy zone, as well as the VIX spiking up into a buy zone as well, the fear index. If you need to play this video over a couple of times, I would advise it, because this is the area where you really get an edge when you start to see all these indicators lining up, instead of being scared out of positions after being in something that you shouldn't be into at present. This is a chart of GTO's bond stock ratio, where we see the S&P 500 broke out of this trend line that goes back to 2007, the peak there, and the peak that we saw in 2012. We broke above that level, and we can see down here under the bond stock ratio, the 10-year bond and the S&P 500, the ratio of the two. We had a 5-year downtrend where we broke above, and we started the downtrend or the bear market that we saw from 2007 down to the spike down in March of 2009. We faded this move here after we saw this move off of that area. That would have been a good buy signal going long. We finally see a crossover of the 65 period moving average, which is this line here. And more importantly, right now we want to watch this low that we saw in 2007 and the low that we're seeing currently. We were in this bull market period right here that translates into the more parabolic move we saw in the S&P 500. And we're looking for a possible crossover now of the 65 period moving average, which would be indicating a bear condition. That doesn't mean that's going to happen. We could see a little spike up and a move back down, just like we saw along this line here, if all these indicators set up and create a situation where we could have a bounce and move higher into the year 2014. But with all of the things that are happening that are catalysts for a move lower, we have to be watching Argentina, Venezuela, China, Brazil, and Europe for clues as to which direction we might be going with further tapering by the Fed. Which leads me to the only area where I'm currently bullish. I am bullish on bonds. I have been since just after the first of the year. People were ribbing me about it. But you can see right here on the 7-10 year iShares that we had a area where we bounced a higher low and we're starting to move higher. We see this Kirby level that we can get above, as well as this level that we put in late October, early November at 102.90 that we could take out in the near future. If we blast through this area, that would be bearish for equities. Looking at the TLT chart, the 20-year Treasury bond fund, we can see that we broke out of this larger pattern that I got shook out of in the summer in this area here. But with this break of this trend line, we can see that this move has been confirmed and is continuing to move higher. We have this level, this Kirby level that we have broken into now, and we can see the force at which we're moving higher, which all led to my decision to get into bond funds early in the year. This is VBTIX, the Vanguard Total Bond Market Fund Index. This follows the Barclays Total Aggregate Bond Index as a benchmark. We can see right here on January 3rd where I entered my first position, anticipating as we moved higher that we would probably take out this previous high that we put in late October, early November, and we did that on Friday. I added on 124 another 50K, and I'm anticipating that we're building the right side of this cup here, a higher low at this point, and we continue to see Bollinger Bands expanding and relative strength on the bonds continuing to move higher. So if you're in your 401k or IRA, as I told some of my friends recently, we're not that far off of this area of a recent buy signal, so I'd be looking for bond exposure going into these next few months of 2014 with all of the catalysts that we spoke about earlier. This is a PEMCO Total Return Fund, a PTTRX, which is also something I follow. We can see the higher low. We can see that we're holding the 20-period moving average on Bollinger Bands. This is a weekly chart. Same with the Vanguard Fund. We can see that RSIs continue to move higher. We are moving off of this level and about to take out a previous high that we put in November. Stochastics is starting to get into overbought territory, but MACD is showing that we could see further area of embedding. So stochastics could embed up here, indicated by MACD crossover and starting to move higher. And finally, a look at currencies and gold. This is a currency chart, the reflection of the carry trade. This is the Deutsche Bank Currency Harvest Fund, DBV. This is something that you should watch, as we got an indicator when we reversed off of this level on Wednesday and Thursday morning that we could see further weakness in equities. A move lower in DBV is bearish for equities, and a move higher is bullish for equities. You can see RSI gave us an early signal or an early tell that we might be moving lower and get rejected at this trend line, which we in fact did. And we saw a gap down on the carry trade on Friday. Note MACD is crossed over and slow stochastics is yet to get oversold. So if you're thinking bullish equities, I would caution you otherwise to just stay on the sidelines for a couple more days and see how these things pan out on Monday. And finally, the chart of gold. We can see that RSI is bottoming on this monthly chart. We have held the 50% level. We didn't get down that far. and we're starting to see a green candle as we move off of this lower Bollinger Band. MACD is starting to turn, and slow stochastics is oversold and could turn any day now. %B continues to move higher as we move away from that lower Bollinger Band. So if you're thinking gold, I would be in small positions, but I do see further upside. As we switch to the weekly, we can see what I'm talking about here. RSI is continuing to move higher, moving off this lower Bollinger Band. Higher lows, splitting hairs here, but this is a higher low. You can start to see people starting to get interested in gold again. MACD is crossing over, moving to the upside with slow stow overbought. %B has a ways to go before it gets to the upper Bollinger Band. That target here at 1350-ish. So that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com. Come check out my site. There's a lot of good information here for new traders that are unsure about what they should be doing currently. My advice to you would be to sit on the sidelines as the markets are selling off here. You can see further downside. I don't see an edge, so keep that in mind if you're a new trader. Even if you've been trading for a while and are unsure about what you might be doing on Monday, Tuesday, I would wait for more signs or more signals to set up before you commit capital in these markets. Alright, take care. I hope this helps, and we'll talk to you in the room on Monday.